Hello Sector Watchers, welcome to the show. This is the 201st episode of Sector Spotlight for Friday the 22nd of December. It's the end of 2023. I'm glad a lot of people watched the 200th episode of Sector Spotlight, which I recorded last week in the studio in Redmond, Washington. I am now back in Amsterdam and I'm going to try to wrap up current asset class and sector rotation and give us a good start on how we are likely going to rotate into the new year. Ladies and gentlemen, this is Sector Spotlight. Asset class rotation. We've got the weekly RRG on the left and the daily on the right, and as usual they're quite distorted because of the strong rotations of Bitcoin. So you see the Bitcoin tail inside leading, still moving to the right on the weekly, and on the daily it's going through a bit of a corrective move. It's coming out of leading, moving in weakening, but if you look at the level of the RS ratio, we're still at very high levels, and given the strong rotation on the weekly, I wouldn't be surprised if we will see a slowdown of the corrective move and starting to curl back up again and start moving back to leading, because the Bitcoin chart is still looking very, very strong. Let's get this out of the way. So here is Bitcoin gone from the weekly, and here it is gone from the daily. And that leaves us with a few other very long tails, and these are for commodities and the US dollar. And you see DJP and GSG rapidly heading already into and inside the lagging quadrant, and so is the US dollar, weakened a lot over the last few weeks. And if you look at the daily chart, you can see that commodity tails are now picking up, but they're doing that at a very low reading on the RS ratio scale. So I am not super fond of commodities at this stage. I think they need a little bit more of a corrective move, very likely. And then the weakness of the US dollar is becoming very imminent. You see the tail of the US dollar just crossing over into the lagging quadrant on the weekly, and you can see how that tail rotated over inside, improving, and is now going down again. So there's definitely some more weakness for the US dollar to be expected. Let me get those out of the way. So that's DJP and GSG and US dollar. And we're going to fit that. And we're going to do the same here for the US dollar and for GSG and DJP. And now you can see the actual rotation of stocks versus bonds. And it was a bit unclear for a couple of weeks, but it's back on track, and it's very clearly in favor of the stock market. We see SPY rotating back up. This is the weekly. We see high yield coming down. We see government going down. And the only one that's reasonably holding up is corporate bonds, LQD. However, if you look at the daily RRG, the picture is much more pronounced. You see the rotation of SPY going through the center and on its way to the move into the leading quadrant. You see GOV and HYG, government bonds and high yield, clearly rotating lower now, and so is corporate bonds rotating out of leading into weakening, and they're all three on a negative RRG heading, whereas SPY is the only one at a positive heading. So taking it from the RRG graphs, at the moment it is a very clear preference for stocks over bonds. Then looking at the individual charts. So here is SPY versus VBINX, which is the benchmark that we use on the RRG. That's the Vanguard Balanced Index Fund. 60% stock market exposure and 40% bond market exposure across various maturities and across various bond asset class. So it's not only government bonds, it's also high yield and also corporate bonds. So SPY is now nearing a heavy resistance area. It's coming into that area just below 480, 475, 480. I think that's going to be a pretty crucial resistance area for SPY. I would not be surprised if we get some sort of a setback in the coming weeks. maybe towards the end of the year, doldrums, etc. Not a lot of buying power present. That area 475, 480 is definitely an important resistance area. If we can break that out, that would be an awesome signal. It would be a very good trigger for more upside potential. If you look at the relative picture, then we see that SPY is still holding up above the former resistance area where we broke out and we tested it. So that is all good from a relative perspective, and you can see how the RRG lines are leveling off and ready to bottom out and move higher, indicating the preference for SPY over VBINX, which essentially is stocks over bonds. If we dive into the S&P 500 again, so don't forget the holiday special that we have running. You can see here a price chart of SPY with the RSI and the MACD. And you can see that 470, 480, 475 area is now coming into play. We very clearly cleared the 460 resistance area. If we come down, then I think that is the first area of support around 460. So that is not too bad for a longer term picture. And if you go to the daily chart of SPY, you can see it a little bit more in detail. So here's that 460 area, and you can see how the RSI has now built up a little bit of divergence between the price peaks, the RSI peaks here and the price peaks over there. And as you have seen on the longer term, 475, 480, we are very near to a resistance area. And so with that negative divergence in the RSI, I'd be very careful with outright new long positions for the time being. I think you will get a better buying opportunity in the next few weeks, but it's not going to be massive. Probably looking in the area around 460 if we get there. Because remember, taking out 475, 480 to the upside is a massive buy signal for the S&P 500. It'll push it to new all-time highs. Everybody has sold over the last year and a half is then at a loss. If they're professional investors and they are short, that's the best because they need to buy to cover their shorts. They have no exposure. Most of these people are in the exposure game, so they have to buy again to create long exposure and participate in the upside. All in all, 475, 480, very important resistance level. If we take it out, super nice. Potentially a little short-term decline in the next few weeks. Before we move on to the current rotation in sectors, I want to point you to the current holiday special that we have running. It's a good time to renew your subscription, or if you are not a subscriber yet, this is your best value to give it a shot. The current state of sector rotation. It looks as if things are clearing up a little bit. I think at least it is less confusing or less random in terms of trends and rotations as we've seen over the last couple of weeks. If you look at the weekly RRG here on the left, there's a few very clear trends visible. The first one is out of energy. That long tail out of energy is indicating relative weakness for the energy sector. Just moved into the lagging quadrant, and it's not going to get out of there very soon. The rally in the daily, you see the daily tail of XLE moving up on strong momentum inside the improving quadrant on the daily RRG. However, it is still on a very low RS ratio reading. So with the negativity of this tail here, I am inclined to interpret this move here as temporary and to foresee that it will start to roll over at some stage before it hits the leading quadrant, roll over back down and get back in sync with the rotation on the weekly. So for the energy sector, unfortunately, I don't think it's too good of an outlook. It's different for example, XLRE, which is quite the opposite of what's happening in XLE. So it's a real estate sector. Nice long tail inside the improving quadrant, pointing northeast. And if you look at the daily, you can see XLRE moving lower. So look at those different trends. XLE straight up here, down here, and XLRE, real estate coming down here and up there. So it's the opposite interpretation. We have a long-term improvement for the real estate sector and a short-term decline. And given the fact that this is the highest reading on the RS ratio scale, I wouldn't be surprised if we will see XLRE in the next couple of weeks to pick up momentum again, turn around, curl back up and move back to the leading quadrant without hitting lagging on the daily graph and join the trajectory of that weekly tail on the real estate sector. What else have we got? The defensive sectors, utilities, staples and healthcare. They're all inside, well, healthcare is already inside lagging. You can see the rotation here, rotating back into the lagging quadrant. That's a negative, as we know. And you can see staples and utilities right here. And they are at low readings, and utilities has already started to roll over, and staples is shortening its tail, and that's usually a sign for an upcoming rotation. And if you look at the daily equivalents of those tails, then we have staples right here inside the lagging quadrant, moving lower here, and a little hiccup, but that's only 1 day. And we have utilities going straight down into the lagging quadrant, very weak rotation. And then there is the healthcare sector doing exactly the same, rotating very weakly into the lagging quadrant, out of improving without ever hitting the leading quadrant. So those three sectors are now rolling over on the daily, that's confirming, and given the fact that they are at low RS ratio readings inside the improving quadrant on the weekly chart, on the weekly RRG chart, I think these defensive sectors are now getting out of favor again. So money is rotating out of the defensive sectors, and that usually is a good sign for the market, especially because the market itself is moving higher. And if you think about that, when money is moving out of sectors and the market itself is going lower, then money has been taken out of the market completely. But now we have a situation where money is taken out of the three defensive sectors, but the market itself is moving higher. And that means that the money that's been taken out of the defensive sector has been redistributed into other sectors to drive the market higher. So all in all, I am judging this as a positive sign for the market as a whole. What other tails are interesting to watch? Obviously, technology. The weekly tail continues to move higher. The pace, it has slowed down, but the direction and the heading is still very good. And if you look at the daily tail, you can see how it went through a bit of a corrective move, and it's now hugging that 100 level on the RS ratio scale and on its way back to the leading quadrant. So it's underscoring the positive trend as we see it on that weekly RRG chart. A similar thing is happening with the financial sector. You can see financials here, just about into the leading quadrant and moving at a nice heading there. And if you look at the financials on the daily, it has come out of the leading quadrant. It's shortening its tail. And given the fact that we have this trend going on here, I'm going to assume, especially when we look at the price chart in a minute, that this is going to roll over and curl back up to bring both the daily and the weekly tails in sync with each other. And then finally, no, not finally, industrials are coming out of leading, but if you look at the weekly, then you can see how the industrials tail is moving into the improving quadrant. The price chart looks very nice. So this is a temporary setback within an improving longer term trend. And we can see how materials is already past that point, because if you look at that rotation here, we moved into leading, didn't even make it to weakening, and already started to pull back up into that leading quadrant. And you can see a similar rotation here where the materials sector has started to accelerate into that improving quadrant. It's still at a very short tail, but it's starting to pull back up. And then finally, I want to look at the consumer discretionary sector. It's one of the most important sectors in the universe. We need that to actually move higher. And you can see here how the daily is rotating through the leading quadrant at a very short tail, very short setback here. That's only today and yesterday. And if you look at the weekly tail, you can see how it's actually curling back up. Early stages, we'll take a look at the price chart in a minute, but I think a couple of weeks ago I made a show that said that the consumer discretionary sector holds the key, and I think that that could very well still be the case, where if and when we see the consumer discretionary sector to actually start participating on the upside, that'll be the sign for a further move up for the market. For now, it's the rotation out of defensives that is kind of driving that money towards other sectors, and as soon as consumer discretionary will start to pick up, take out resistance levels, we've got both technology and discretionary doing very, very well on the RRGs. And don't forget about financials. We'll look at the chart in a minute, but the financial sector, I think, is really coming to life. And on the back of that, also the real estate sector moving into that right direction. Let's take a look at some of the individual charts. The first one, materials. If you look at materials, let me bring it up here. You can see how that tail has been shortening and actually start to pick up into the right direction. And the reason, it's very early, but you can see it here, is that we're about to take out this falling resistance line, and you can see how the RRG lines have been kind of moving in parallel sideways, and that's when the tail shortens. That's where you can see how that tail has become stable and it didn't move much. That's why when you see this type of behavior, that means that the tail is getting very shorter, stable, and doesn't go anywhere. And when the lines are diverging, that's when the tail expands and gets longer and longer, indicating a little bit more power behind the move. But the combination of taking out resistance on the relative, but also taking out overhead resistance on the price chart, basically freeing the way for a move to, at first, I think 88, is a good sign for the materials sector. So that's one of the improving sectors, and it's obviously one of the more offensive sectors. The second chart is for the energy sector. And we've seen that tail moving lower. You can see how that moves. You see the difference between those RRG lines, where the materials sector, there was for a long time, they were sideways and the tail shrunk and was very short. Here you can see that they moved over, and in this particular position they're moving lower. And you can see how that causes that tail to lengthen, to expand and move into the lagging quadrant. We're resting at support in terms of relative strength, and we have just managed to stay above the rising support level on the price chart. All in all, the outlook, the relative outlook for the energy sector, I don't think not too strong for the next couple of weeks within the universe. There are other sectors that are doing better at the moment. Financials. If we look at financials, one of the more important sectors, and you can see how it started to improve into the leading quadrant. That is happening right here. You can see those RRG lines slowly starting to point higher. We may need to take out that former support line now acting as resistance, but I could also argue that we have a very shallow series of higher highs, higher lows underway. Things are looking better, but I think we will get support from the fact that the price chart has broken above a pretty important resistance area. It's holding up there, and it frees up the way for a move to, I think it'll be like 41 should be possible. This previous peaks here from December 2021, quite a time ago. So we had this long trading range here, and this is looking good from both a price and a relative perspective. And if we look at industrials, that is one of the stronger sectors. It's trading at new all-time highs. We took out that former all-time high and we're holding up well this time. And you can see how relative strength has bounced off support from previous highs and then a previous low, and it's now moving higher. The RRG lines are responding, and so is the tail on the RRG, starting to push XLI into that positive RRG heading. So together with the materials sector, another kind of offensive sector that is moving in the right direction, starting to attract more money, which is very likely coming out of these defensive sectors. And now we've got technology. We can't do without technology, and it's still a very good tail. And you can see here how we kind of had this small consolidation pause area, we got out of it, accelerated, we're now trading at new all-time highs. So is relative strength, RRG lines are looking good. By all means, this is a bit of overstretched rally, but you can see, I hope you agree with me, that any kind of setback, I think, should only be seen as a healthy pullback within a very well-established uptrend in the technology sector. Here we have real estate. It was one of the worst sectors for a very long time, and it looks as if it's improving now. We're coming out of this downtrend, almost 2-year downtrend. We have already taken out the previous high. I'm not sure, we still need a higher low, at least one of this magnitude, so we probably need to see a little bit more of a setback. But look at the relative strength. There is a bottom forming process underway, and you can see how the RRG lines are picking this up once again, pushing the tail inside the improving quadrant rapidly towards leading. And then here is utilities. We're going into the defensive sectors. You can see how utilities is way lower than real estate. They're both inside the improving quadrant, but they have different characteristics, different tails, and utilities has already started to roll over. And if you look at the price chart of utilities, then you can see that the price has just bounced off that falling resistance line, and look at the falling trend in relative strength. This is a very clear, solid relative downtrend. And the fact that the RS momentum line has picked up here is due to the fact that we've got for a couple of months, well, not even months, a couple of weeks of more sideways movement that lowers the downward momentum, that's causing that green RS momentum line to get some form of a relief. But the RS ratio line is still well below 100. And if that downtrend resumes, momentum will very rapidly respond, and we will have both RRG lines below 100 again, pulling that utilities tail over and back down towards the lagging quadrant. If we look at healthcare, situation here is a little bit more pronounced. It's ahead of the game in terms of defensive rotation. You can see how it is still caught within the boundaries of a trading range. We're nearing a pretty heavy resistance area in the healthcare sector. But if you look at the relative trend, where it's a very clear series of lower highs and lower lows. Let me put my cursor here. We're now getting to a support area back November 2021. If that gives way, I expect an acceleration lower in terms of relative strength for the healthcare sector. And you can see how the RRG lines are already discounting such a move. They're already preparing the rolling over for an acceleration lower. And then finally, the last chart that we need to look at is consumer discretionary. As I said, it's in the early stages, but look at the move here in terms of price. We have cleared overhead resistance coming out of this, these summer highs, summer 2023 highs. We took them out, we're holding up. The next level to watch is around 185, and we're still inside a sideways move in terms of relative strength. But if we can maintain this improvement here and reach that upper boundary, and the price remains pushing, that could be the catalyst, the accelerator for relative strength to get out of that range and start a new up move. And then we will have consumer discretionary as one of the more driving forces behind a further market rally. And this concludes episode 201 of Sector Spotlight, and it also completes a full year 2023. I hope you enjoyed watching the show, and I am hoping sincerely that you will stay with us in 2024. So I will take this opportunity to wish you a very happy holiday season, a Merry Christmas, and a very good start of the new year. And I'm looking forward to seeing you again in a new episode of Sector Spotlight in the first week of January.